In 2003, one Wall Street trader quietly made a bet that would later prove the entire financial system was broken. He predicted the housing crash years before anyone was talking about 2008, and he was right. But that very same trade, the one that proved his genius, would later cost his bank $9 billion and become one of the single worst trading disasters in Wall Street history. This is the story of how being right can go catastrophically wrong. To understand this story, you first need to know who Howard Hubler was. He wasn't some rogue trader or a Wall Street outsider. He was the opposite. Hubler was a star bond trader at one of the most prestigious banks in the world, Morgan Stanley. He was so good and so trusted that the bank gave him billions of its own dollars to manage on a special team called a proprietary trading desk. His job was to find opportunities in the market and make the bank money. By the early 2000s, while the rest of Wall Street was celebrating a booming housing market, Hubler noticed something deeply disturbing. He saw banks handing out mortgages to people without even checking if they had a job or any income. This was the era of the ninja low-no income, no job or assets. He saw home prices soaring to levels that made no logical sense, completely detached from reality. Most importantly, he saw that the big banks weren't actually getting rid of the risk from these bad loans. They were just slicing them up, repackaging them, and passing the risk around to each other like a hot potato. While everyone else saw a party, Howard Hubler saw rot at the very foundation of the system. So, in 2003, years before the mainstream even caught a whiff of trouble, Hubler made a bold, contrarian move. He decided to bet against the U.S. housing market. He started shorting subprime mortgages using a financial instrument called a credit default swap, or CDS. Now, a CDS sounds complicated, but the idea is actually very simple. It's basically an insurance policy. Hubler was paying a small premium to an insurance company, and in return, they promised to pay him a huge amount of money if and when these subprime mortgages started to fail. Think about that. In the mid-2000s, almost no one believed the American housing market could ever go down. It was considered the safest investment on the planet. But Hubler went against the entire industry. Hubler was essentially betting that the whole system was a house of cards. And for a while, it looked like he was a lone wolf, crying in the desert. But then, slowly, the data started to prove him right. Delinquency rates on those subprime loans began to creep up. The first stress cracks in the foundation started to appear. And Hubler's trade, the one everyone thought was crazy, started printing money. He was on his way to making a legendary profit. But there was just one problem, a very expensive problem. Being right is one thing, but staying solvent while you wait to be proven right is another. Those insurance premiums he was paying on his big short position were like a constant leak, draining cash from his accounts every single month. The longer the housing market stayed afloat, the more money he was bleeding. His genius trade was slowly eating itself alive. So Hubler and his team asked themselves a fatal question. How can we pay for this trade? How can we fund our brilliant bet without running out of money first? The answer they came up with seemed, at the time, completely harmless, even smart. He decided to sell insurance on something he believed was perfectly safe: the highest-rated mortgage bonds. These were the so-called super senior AAA-rated tranches of mortgage-backed securities. On paper, they were the absolute safest part of the housing market. They were considered practically risk-free. All the major rating agencies, Moody's, S&P, gave them a perfect score. Pension funds and governments held them as rock-solid investments. To Hubler, this was a perfect hedge. He would use the small, steady income from selling this safe insurance to pay for his big, aggressive bet against the risky part of the market. Howard Hubler was convinced that the bottom of the market, the subprime junk, would collapse. But he was equally convinced that the top of the market, the AAA-rated bonds, would survive. He was half right. And that assumption, that one blind spot, is what would turn his genius trade into a $9 billion catastrophe. In Part 2, we'll dive into how that single, seemingly safe decision not only destroyed his career, but nearly took down Morgan Stanley itself. Make sure you're subscribed so you don't miss it. Thanks for watching.